after my mom died. So my brain is swimming.
Yeah.
I had a friend who I asked to because I didn't want my cat sitter to do it. You know, can you open a bill from such and such a company? I just need to see.
Good afternoon, everybody. Welcome to the Insurance and Real Estate Committee's Nonprofit Liability Working Group. Today is Friday, October 17th. We are going to start with some presentations today, but again, just to refresh everyone to why we are here. We are here because insurance across the board for nonprofits is either not accessible or unattainable, or about to become unattainable. And so this emergency working group has been convened to come up with solutions by the end of the year and present that to the legislative session and hopefully try to solve some of the issues that we're facing right now in this crisis mode. Any other comments or opening remarks from anyone? Okay, great. Why don't we just quickly go around the room and do super quick introductions for those that are here and those that are online, and then we will head over to the presentation. My name is Carrie Wood. I'm the state representative from Rocky Hill and Wethersfield, and I have the honor of serving on the Insurance and Real Estate Committee with my Vice Chair, Jill Berry. Sweet.
I am Jill Berry. I am the state representative for the town of Glastonbury. Very happy to be here.
Hi, I'm Brooke Foley. I'm from the Insurance Association of Connecticut, and I am representing the property and casualty insurers.
Good morning. I'm Kristen Dadanowitz. I'm here from the Connecticut Office of Early Childhood.
Good afternoon. My name is Terry Calderon. I'm an attorney with the Connecticut Insurance Department.
Brian O'Connor. I'm the Director of Public Policy for the Connecticut Conference of Municipalities.
Hi, I'm Ben Shakin. I'm the Director of Public Policy and Advocacy at the Connecticut Community Nonprofit Alliance.
Good morning. Mike McGlaris, Principal of Michael McGlaris and Company and Superintendent of Connecticut Foundation Solutions Indemnity Company.
Hi, my name is Lisa DeMattis Lepori, and I am the CEO from The Connection.
Katie Stargarter. I'm the Undersecretary for Legislative Affairs at the Office of Policy and Management.
Thank you. Anyone online like to introduce themselves?
Ava Bermuda Zimmerman from Childcare 4CT Statewide Childcare Advocacy Group. Thank you.
Hey, Maggie Adair, Office of Early Childhood.
John Carl Casa. I'm the President and CEO of the Connecticut Community Nonprofit Alliance.
Deb Fliss, Office of Early Childhood.
Jillian Gilchrist, State Representative from West Hartford, Co-Chair of the Human Services Committee.
Meg Dreyer, representing SRO.
I'm Carson, Connecticut Insurance Department.
George Brodner, Connecticut Insurance Department.
Sloan Buckowitz, Connecticut Insurance Department, Commercial Examiner.
All right, thank you, everyone. At this time, we will turn it over to Michael Maglaris, who is going to give us a presentation on captive insurance and the success of CISIF, which is the acronym for something a lot longer, which we'll hand it over to Michael.
We are grateful for that acronym. When I gave you the whole name of the captive, the name of the captive is Connecticut Foundation Solutions Indemnity Company. It holds captive license number 29, issued by the Connecticut Insurance Department. CFSIC, CIFSIC for short. So that's what we go by because it's easier to pronounce. Representative Wood, Representative Barry, all other representatives and or ranking members on the call. I'm delighted to be here. My name is Mike Maglaris. I am the founder and principal of Michael Maglaris and Company, a captive insurance underwriting and consulting firm headquartered here very proudly in Connecticut. We celebrate our 40th year in business with 148 captive licenses. We are the oldest continuously operating captive underwriting, feasibility analysis, and management company in Connecticut, the second oldest in the United States. Among these captives that we're privileged to manage and provide outsourced services is CIFSIC, Connecticut Foundation Solutions, which is a pioneering public-private partnership, funding from the state of Connecticut coupled with independent outsourced management and related services from the captive insurance industry. My firm has, by way of background, pioneered captive underwriting programs providing liability and property and workers' compensation and employers' liability insurance, including pooling mechanisms. For those 40 years, we specialize in tax exempts. 80% of our revenue stream comes from 501c3s. During the last deep liability insurance availability crisis, which effectively ran from 2002 to 2007, we formed captives writing professional liability and other forms of insurance coverage for St. Francis Hospital and Medical Center, Mount Sinai Hospital, Waterbury Hospital, St. Mary's Hospital, Norwalk Hospital, Stamford Hospital, Bristol Hospital, as well as the largest obstetrical practice in Connecticut, Physicians for Women's Health. I also formed Connecticut Medical Insurance Company on behalf of the Connecticut State Medical Society. We are used to dealing with a crisis like this. It doesn't make the crisis any less of a crisis. It just makes it a crisis that some of us, older veterans in the industry, of which I count myself, unfortunately, as one of them, have dealt with before. And if I could make a comment to the Alliance and to its constituent members, this is a crisis that we will overcome. How do I know that? Because in 2003, 800 OBGYNs marched on Hartford. It was called a White Coat March. I was there. They demanded relief from premiums for obstetricians that had gone from $64,000 a year to $171,000 with no change in coverage. In fact, with some restrictions. If you were an OBGYN practicing at St. Francis or Hartford Healthcare or Stamford or Norwalk Hospital facing that crisis and where you were only paid $1,200 per live birth, if you do the math and you divide 171 by $1,200, you see the intensity of this crisis. I had meetings at Bay State Healthcare. They were prepared to start establishing birthing centers across the Massachusetts northern border to absorb the flow of OBGYNs out of the state of Connecticut. That is why I say categorically, Representative Wood and Representative Barry, this crisis that tax exempts are facing, particularly in caring for underserved populations and for our youth, is a crisis we will overcome. If we could overcome the OBGYN crisis, we will do this one as well. And I give that ray of hope and thought of hope for everyone present in the room, because I firmly believe what I've just said. I have seen it all in this industry. It is my 47th year in the insurance industry and my 40th year as a self-employed practitioner in essentially what is self-insurance, captives and pooling mechanisms. We will get past this, and it will work. And it will work through a combination of good claims management, good risk management, and sources of capital. Speaking very specifically about CFSIC, about the Connecticut Foundation Solutions Indemnity Company, you see, I think at the top of the page, you see a house that has been raised 9 feet off the ground. Not only is that something of an engineering feat, but it is how we, in fact, restore the equity in that home to the homeowners who have suffered through this crisis. Let's go to page 2, if we can, please. The standard definition of a captive, and there's a captive law in Connecticut, it's a very good law too, a limited purpose insurer that underwrites the risk of its parent or parents and affiliated organizations, and which may underwrite risks closely associated with parent or affiliate operations. There's an alternative to that definition, which has come into prominence with CFSIC. A limited purpose insurer organized as a public-private partnership for the purposes of assisting in insurance coverage availability, affordability, and societal benefit. We are not the first. The first is the World Trade Center captive, still in operation, formed under the captive law in New York State in 2002, and right now still participating in serving the families of the first responders to the 9/11 crisis. We are the second, and we are the model being used now in Arkansas to restore property insurance to homeowners there. This model, the Connecticut model, is now under consideration in the state of Washington, where a crisis of equal proportion exists for tax exempts serving children and others in the state of Washington. I've been there. We've had these discussions. This is the national and international model that is being used, and Connecticut should congratulate itself on its forward thinking. So let's go to the next page. This is a little graphic that I like to use sometimes in discussing captives. The Connecticut Insurance Department is a forest with 3 trees. On the left are admitted markets. Hartford, Travelers. You all know the list of major limited, or rather admitted insurers like Liberty Mutual, etc. Non-admitted markets, markets that choose not to be admitted because they are opportunistically looking at business opportunities here in the state of Connecticut on a non-admitted basis. And the third tree are captives. Does that graphic exist in the state of Massachusetts? Absolutely not. Why? There's no captive law. 27 jurisdictions in the United States have a captive law. Can you form one in Maine? Yes. Can you form one in North Carolina? Yes. Can you form one in Massachusetts? No. Can you form one in Connecticut? Absolutely. That's why the major tool manufacturer, Stanley Black & Decker, has their captive here. That's why the news service, Reuters, has their captive here. That's why Massonicare has its senior care and senior living liability captive in Connecticut. I know I formed it. It is a wonderful domicile, and we've got a great commissioner who's forward-thinking and a great regulator of captives. But notice their interlocking relationships. Captives work best when they collaborate with the insurance market and not oppose it. Captives need reinsurance. Parents need excess insurance. And all of that is a symbiotic relationship among those 3 trees within one insurance department. We are regulated very tightly by the Connecticut Insurance Department. We report to them on a quarterly basis, our financial results, and of course we report to the Department of Housing as well. Let's go to the next page. How are these things used? It's very important to understand that they stimulate, augment, and sometimes replace. We stimulate the commercial market to stay in the game. Countless times, the captives that we formed, and we, as I said, formed 148 in 40 years, what they've done is they've participated with the commercial market to keep the commercial insurer actively underwriting rather than abandoning the marketplace. That's really important. Can you write workers' compensation insurance on a direct basis in a captive insurance company? No, you cannot in Connecticut. But you can participate in a workers' compensation program with a captive where a commercial insurer is issuing the policy. And that collaboration is enormously important for the future of tax exempts. You can augment coverage by expanding limits, controlling pricing, manuscripting coverage. In the last 7 years, every one of the captives we actively consult with, including this one, every captive we actively manage, we have 31 in our stable right now, has had to manuscript individual coverage for sexual abuse and molestation. Why? Unavailable. I'm at Lloyd's of London about every 8 to 10 weeks, and I can tell you that Lloyd's has shut down over sexual abuse and molestation. You know that from your experience. If you need insurance coverage, you need to defend innocent parties, which are frequently enjoined in actions involving sexual abuse and molestation. You need to augment coverage. You do it through the use of reinsurance and excess insurance for sure. That's that collaboration. But to be key, manuscripting of insurance coverage is very important. Replacing coverage. That's CIFSIC's mission. The commercial insurance market said no to these homeowners. We have replaced, as of this morning, 1,169 families back in safe and secure homes. All of those homes were denied insurance coverage by the commercial market. So we stimulate, we augment, we replace. So the next slide details the crisis. It's important to understand the crisis because insurance crises have a lot of similarities when you think about them. There's a mineral called pyrrhotite. It's an aggregate. Aggregate represents 60 to 80% of this of the concrete in your foundation. It's a mixture. It's water, it's admixtures, it's aggregate. Pyrrhotite is found in quarried aggregate. And if you can see my hands, you can see this band cut right through the center. Here's 84, and here's this band that starts just about north of Hartford, runs up into Massachusetts, where there are 4,000 families with this problem, touches the border of Vermont, hits the border of New Hampshire. And that red mass of pyrrhotite, when exposed to oxygen and to air, begins to erode. And when it does, your foundation crumbles, it deteriorates, it sags, you can't close your front door, and overnight you lose upwards of 60% of your home's value. Very significant loss of tax revenue to every one of the 43 towns affected. And we'll talk in a moment about what we've returned at CIFSIC in terms of tax revenue. So on the next page, Governor Malloy, who was a very strong advocate of our captive law and emphasized that to me on a number of occasions when we met, Governor Malloy signed the legislation enabling CIFSIC to exist on October 31, 17. And Rep. Wood and Rep. Barrett, that's the key. This was legislated into place. Extremely important. One more slide. Thank you so much for noticing that, Rep. Wood. CIFSIC was incorporated on June 27th of 18. Our firm started almost immediately upon incorporation. Our license was granted on August 8th. That spread of time between June 27 and August 8 is vital to your understanding. Normally 4 to 5 months to get a captive business plan, feasibility study done, presented to an insurance department or regulator, in this case, Connecticut. Andy Mays and his team worked with me and my team, and we fast-tracked this. It's a testament to how well the insurance department collaborated with us. November through December 18, we built our claims management structure. We have an entirely AI-driven electronic claims management and application process. The application and the management process is on claims is outsourced to Chubb, the division of the insurance company Chubb. In fact, every function in this captive is outsourced. It has no employees. Why? Because that's the leanest and meanest way for most captives to operate. We have gotten to date pledges and actual cash of $410 million to fix this problem. And we have been determined to be a 501c3. Well, we are tax exempt, ready and willing to perhaps assist tax exempts as well in this incredible struggle that they're going through. That was fast-tracked as well. On page 7, the very next page, Alice. What are these 5 issues? And how did this underwriting program address them? The problem is the mineral pyrrhotite. The commercial insurance market will not cover pyrrhotite deterioration. It's not a property insurance covered peril in your homeowner's policy. Very important. Pyrrhotite infection renders a home uninhabitable at some point, and the Connecticut Supreme Court, I should say, ruled against homeowners in that particularly important decision in November of 20. 8-digit erosion of assessable tax value in 43 towns, and we have replaced 87% of that tax abatement problem since January 10 of 2019. Lost home equity, negative equity. We have many young families in homes where suddenly the value of their home is less than the mortgage they owe. Bankruptcy after bankruptcy after bankruptcy. Family strain, homelessness. We have strived, and we think in our own modest way, Rep. Wood and Rep. Berry, to keep people in the towns they live in and to keep tax revenue flowing to the towns. The very next page is a very brief graphic that shows the operational structure. This is a captive insurance company under the statute. As I mentioned, we hold license 29, but it is something called a protected cell. A protected cell captive was originally a discussion that I had both with Governor Malloy and with Commissioner Mays, because Massachusetts was considering joining our effort back in 2020, because there is no captive law in Massachusetts. Massachusetts has taken its time to do that, and they are not in this program in any way, shape, or form. But a protected cell program allows multiple cells to multiply under one structure. And it is important for all of you to know that those cells do not have to write or underwrite like insurance coverage. What's the key? Is if Massachusetts came on board tomorrow, and they're not going to do that, but they are going to come on board at some point because they're optionalist, their cells' assets and liabilities would be completely segregated. A claim within CIFSIC couldn't impact a claim in Massachusetts. A claim in Massachusetts legally could have no effect on assets in Connecticut. It's an important point. This is a segregated cell, and a segregated cell structure is used very frequently in Connecticut. In the state of Delaware, they proliferate. They're a very important part of the captive movement. So our success, on the next page, if you would. We were created through statute. That's key. We were legislated into existence. But here's what's really important. If you actually take a look at the enabling legislation, it is the barest architecture of what you all at the legislative level said this captive should look like. In other words, you didn't legislate us to death. You said, go form a captive, hire a superintendent, create a volunteer board. Here are the types of people we need on the board. You were very clear in the outline of what you wanted this thing to look like. And then you tossed it back to the commercial captive industry and said, go do it. And that collaboration between good legislation, good architecture, good structure, and throwing it back to the professionals has resulted in what we think is the success we see now. It's a public-private partnership. We have a board of directors, 14 people, 4 of whom are sitting elected officials, ex officio members. We have a representative of the banking industry, the real estate industry. We have 3 people on our board who have suffered through this crisis. So that when we start to go astray in our thinking, they bring us up short and say, remember the victims. And that's an extremely important point. Our expenses are capped. We'll talk about that in a second. And our captive structure is a protected cell. Talking about a financial snapshot, which is the very next page, Alice. We've received to date 266 million, combination of revenue bonding and something called the Healthy Homes Assessment. Everyone in this room, I'm assuming, purchases one of the 6 forms of homeowners insurance, 1 through 6, to cover your property and your liability of your dwelling. Every time you pay a premium on an annual basis, you pay $12, of which we get 85% of that number, roughly about $11 million a year. So our funding currently is a $25 million a year bond allotment, revenue bond allotment, and roughly about $11 million from the Healthy Home Surcharge, that $12 that each one of us pays. $36 million a year is our revenue source. We've gotten $266 million to date. Our general and administrative expenses are capped by statute at 10% of our calendar year revenue. The company has been managed at an annual average of 3.7% since inception, and that's an audited figure. We are audited twice a year, statutory audit, which is required by the insurance department, and a second audit, which is provided to OPM and to the treasurer. So every one of our processes is examined twice. It's what happens, and we are into our 7th audit. The last 6 are posted on our website for public consumption. The very next page, Allison, we've created more than 225 construction jobs. These are permanent jobs doing this work each and every day of the week. We've instituted a claim transfer process, a novel process for this public-private partnership. If you're a claimant and you can't tough it out anymore, you can't wait another year and a half for us to lift your home and replace your foundation, you can sell your home and transfer your exact place in line to the buyer. An incentive for that sale, an incentive for someone coming into the state, for example. We have a lot of people from Massachusetts who want to buy in the affected area, particularly young families, and they take advantage of that because they assume someone's place in line. It's a very, very unique and we think thoughtful way to handle it. We have shored up the grand list, and the grand list was suffering. We're talking about property tax assessments of $4,500 to $5,000, suddenly overnight dropping to less than $2,000 because of the crumbling foundation. We have improved 87% of that. And we've kept people in their homes, in their communities. This public-private tax-exempt partnership utilizing a captive insurance company. I've formed a lot of captives in my time for tax-exempts and taxable entities. This one gives me the most pride. This is my way of giving back to the state of Connecticut, which has been good to me. It's been my way of giving back, Rep Wood and Rep Barry, for the many years that we've enjoyed a prosperous business relationship here in Connecticut. And the beauty of this captive is it was legislated into existence to create an environment to solve a problem. And we think it's done very well doing that. I thank you all for your attention. I'm happy to take questions or have any comments.
Please just raise your hand online if you have questions, and in the room, just raise your hand if you have questions. I will start. So you said we have a $12 surcharge on our homeowners that collects about 11 million annually.
Yes.
And you've collected about 266 million. In turn, that has insured about 400 million of replacement.
No, we are due with the cash you've already got, plus the cash that it allotted this last go around of the session, and the remaining healthy homes. We are due about a total of, from inception, 410 million. We have paid out, as of this morning, $201 million in claims. We have cash on hand for the claims that are coming. We have to maintain statutory reserves on our books for claims that we know about. Obviously, that's a requirement. So we're going to be spending that money.
Okay.
When this company sunsets, will I return some funds to the state of Connecticut? Absolutely. Will it be 100 million? No, because we will have replaced those homes. But I'm determined to send you back $10 to $15 if I can do it. Yes.
Right. So the other thing I wanted to ask is just looking at kind of putting a similar hat on. So I'm trying to do the comparisons for CIFSIC to the problems that we're having with the liability and other insurance coverages. What kind of investment do you think the state would need? I mean, I understand, I hope all of us in this room understand that the state is going to have to invest in this problem. And with all these solutions, I think it's good for us to understand what each of these solutions that we're looking at costs. What do you think something like this would cost in terms of initial investment and ongoing investment? And then how the nonprofits, like, would we, the nonprofits have said, we're not looking to pay nothing. We're looking to just keep these costs capped. We're still going to participate, but if something goes away, that's the worst case scenario. So, what are we looking at in terms of what the nonprofit's role is, what the state's role is?
I'm going to put my head in the noose and tell you exactly what I think, and then we'll catch up in a year's time or more to see if I was right or I was wrong. This can move into a captive that looks in some regards like CIFSIC and some regards not at all. Let me give you an example. CIFSIC's claim liability is capped at 190,000. 190,000 isn't going to cut it here, but CIFSIC was designed that way. If CIFSIC could have been created to pay a claim of 1.9 million or 19 million or 190 million, our largest captive in terms of the limits outstanding is $100 million a year. So it's the availability of reinsurance, the availability of a good symbiotic relationship with the commercial insurance market. And I'm a great believer, as I said last time in my comments, about collaboration with the commercial insurance market. I think that's extremely important. Whether it's in an insurance collaboration or a reinsurance collaboration, it's going to happen. If this is limited to the state of Connecticut, and trust me when I tell you at some point it won't be, okay? It's just, that's the way it'll happen. But if this underwriting is limited to the state of Connecticut, involving the members of the Alliance and other like-minded souls who might come into this, and a good feasibility analysis and business plan is created, which is key to your understanding of what's needed. It is much smaller than CIFSIC. It is on the order of 50 to 75 million. And what is needed is the opportunity to attract the reinsurance and capital market, insurance market to this endeavor. You need paper, whether it's through a pooling mechanism or an insurance relationship, you need paper to deliver to somebody, a policy. And that's particularly a key part of the workers' compensation and property business as well. So I'm guessing it's under $75 million. I'm guessing that capital and surplus doesn't come in tranches. It's appropriated all at once, because when you go out into the world and start negotiating with the commercial insurance market, you've got to have capital behind you. But the key is the feasibility analysis and work plan for this captive will reveal what's the basis of the risk. The actuarial analysis will be conducted. The business plan analysis will be conducted. We will want this thing to be a tax exempt to the extent we can, and group captives are difficult when they're group captives, and keeping their tax exempt status will work through that issue. But here's what's really important. The CIFSIC model has proven itself because you gave us upwards of $3.5 million a year to manage this insurance company, which is 10% of our calendar year revenues. And we do it for 3.7%. And we do it with outsourced service providers and not a single employee. So, and we have tremendous oversight. I'm reporting constantly to the legislature, to the DOH, to the OPM, to the Treasurer's Office, to Andy Mays at the Commissioner's Office, to Fenwalu, and our audits are online. So at the end of the day, be thinking in a smaller version of CIFSIC, a smaller capital commitment, but one I think that is meaningful enough to get the attention of the commercial insurance and reinsurance market with whom we will have to collaborate. Does that answer your question?
Yeah, it answers my question. I think I want to, probably the nonprofits are going to ask this, but like, don't we still have to talk with Our friends on the Judiciary Committee, our friends in the Trial Bar
Yes.
Association on claims and capping those, perhaps even talking with the Attorney General's office on some of the language. I mean, I think there's a lot that needs to happen as well. It's not just this in a bubble. It is multiple other things need to happen and players need to be at the table. Am I correct?
You are correct. I don't wish to be negative and I don't wish to be pessimistic, but for 40 years, I have battled with trial lawyers in the state on behalf of the captives we manage that write under professional liability in the state, ensuring physicians, nurse practitioners, RNs, the surgical suite, the list goes on and on. Before I head to that big captive in the sky, Rep. Wood, I want us to see Virginia-style tort reform. The Virginia Act is the best in the United States, and I want to see it here. Am I going to get it with this arrangement with our tax-exempt members of the Alliance? I'm not saying we don't try, but that is a tough one, and it's going to be a tough one for us. What is instrumental in making this work for me is risk management. When the insurance market walks away on a risk, when they say we've had it, when Lloyd's of London, with whom I have a 45-year business relationship, when underwriters walk away in meetings that I'm at in London with them and say, we're not touching this risk, they do it for a reason. They've hemorrhaged cash. So we must enhance risk management to the nth degree. We must weed out those practitioners who are not doing the right job. We must create an environment of safety and fulfillment for the young people that are being cared for here, or nobody will come to our party. And so risk management is key, as is claims management. Captive claims management, very much different than the commercial insurance market claims management structure, and of course, what we do. But what's critical is, without managing risk and showing people how to do it better, you'll spend money, you'll authorize funds. That candidly will be wasted. If we're going to take one more crack, a good strong crack at trial bar on this one, plaintiff's counsel, I volunteer and you've got me on your side. But boy, have I've got the shrapnel that will explain how rough that job is. It's not impossible, but it's been tough.
Thank you. I will ask some other questions. I see Senator Kathy Austin. Senator.
Hi, how are you? Hi, Mike.
Hi, Kathy.
How are you?
I'm great. Thank you. Thank you, Senator.
So a couple things. One, I just, think people may not understand how we got to this place today. We moved our nonprofit work out of state government into the private nonprofit realm, but 99.9% of the funding for nonprofits already comes from state government. We pay for these services, and the lack of insurance for the sexual assault, sexual harassment realm of things is going to negatively impact other services that we pay for in the state. People will stay incarcerated longer, and when they get out, they will have no services at all, which will put them in the communities they end up residing in some difficult situations. I think that we have to understand that this was all always being paid for by the state. Now, when it was done by state government, there were caps on what could be paid out. When we moved it out into the private nonprofit world, those caps went away. And that has led to this problem promulgating itself across, not just across Connecticut, but across the nation. So I just wanted to say that we really have to pay attention to this, because this is not something that is going to go away, and the services necessary are not going to go away. Relative to the captive insurance market, the captive insurance market saved Eastern Connecticut relative to getting people back in their homes. Without the CIFSIC organization, we would not have gotten those people back in their homes, and those communities would have actually crumbled on themselves because they would have been left with crumbling foundations dotted all across their community and no ability to fix it and no ability to collect any tax revenue on that. I sat on planning and development as chair when this first came to our attention. I am also very interested in looking at a captive insurance market for fire cancer cases. I think that that's another area that we're going to see some problems. You and I have had very brief conversations about this. First, I want to thank you for the work that you do. Second, I want everybody to realize that this problem is not going to go away. There are going to be problems relative to this if we don't take care of it. And I think that we do need to invite our colleagues, and whether it's as co-chairs for insurance and judish, that may be where we have to go and have these very basic, hard to discuss problems. Again, I want to thank you very much, Mike, and thank you, Rep Wood and Rep Barry, for being there, and I apologize for not being there.
Thank you, Senator Aston. You're always here, so it's okay when you cannot make it into the building. Yeah, we did invite the co-chairs of the Judiciary Committee, and we did have a member of the Judiciary join us today, Representative Gilchrist, who's also chair of Human Services Committee. So this committee is not closed to anyone that wants to participate. We also invited members of the Bar Association, correct, and the trial bar. So we will continue to try to bridge that divide and have them at the table so we can have those discussions. I think that's a worthy discussion in a future working group. Representative Meskers.
Thank you very much. One, I wanted to again extend my thanks from Commerce for the work that's been done so far with crumbling foundations. As far as this goes, this is just yet another problem that we have to get our arms around and resolve in terms of ensuring some type of insurability for our nonprofits. So you can count on my help on Commerce to the extent that we can weigh in on this, because I think it's imperative that we figure out our way forward to provide affordable insurance, liability insurance to our nonprofits, because as Senator Austin mentioned, this is work that the alternative is the state with its caps or coverage and its expenses. So I think having the nonprofits involved is crucial, and figuring a way to support them and figure out the way that we in the state on a budgetary basis can help seed a captive insurance, I think is crucial. So I want to thank you for the work on this.
Thank you, and glad to have you participate as chair of Commerce. Representative Farrar.
Oh, thanks, Representative Wood. Just had to call in today, and thanks for the presentation. Happy to be here, and for me, most interested in being here, especially in working with so many folks on the early child care and education side and how this affects them. So I was curious from our speaker today, he had mentioned a little bit about how in the captive market, the claims process and the risk management process is often different. And I was hoping if he could share a little just bit more information for those of us who aren't familiar with that, how that would be different in the captive insurance market. Thanks so much.
Happy to do that. The focus of any captive insurance company, its main reason for living, its main reason for being is to pay claims. But then that's true of the commercial market. Insurance companies protect assets. They issue insurance contracts. You pay a premium, you get an insurance contract back. You have some asset or something protected. Captives do the same thing. But here's where the difference lies. the very excellent work that the commercial insurance market does every day of the week with automobile liability and workers' comp and property and liability insurance coverages of all kinds, and cyber liability, which is a growing significant threat. The excellent work that's done is done on behalf of insurance policies that are issued by those insurance companies under a duty or a right to defend. What does that mean? It means you give me a premium, and if you give me a claim, I have the obligation to defend that claim and address it and hire counsel and adjust it and compromise it and get rid of it and pay it. With a captive, every single claim you have hurts. It's your claim. It's your captive. You own it. If you go to the risk manager, the senior vice president of risk management at Stanford Healthcare, Ruth Cardiello, and you ask her whether or not every single claim she processes through her captive is a major, major opportunity to improve a process or a procedure, she'd answer an emphatic yes. Why is she doing that? Because she herself, with her team, is adjusting that claim. So the claim structure is different, the skin in the game is different, the psychological impact is different, and now go to risk management. Any endeavor in the captive industry will fail unless risk is managed. And in point of fact, some of the best sources for getting risk management help for these tax exempts, and I've talked to the people that manage in Washington the ACEs scores that many of you have used. We have an ongoing dialogue on ACEs scores issues and the effect on underwriting. Anyone will tell you that some of the best sources for the management of risk is the commercial insurance market. You having problems with automobile liability and physical damage? The Travelers, the Hartford, the Liberty Mutuals of this world are very happy to share their knowledge with you. All the captives we've built have been symbiotic. The captive gets formed, we take risk, we collect some premium, we share it with the commercial insurance and reinsurance marketplace, and we go back to that marketplace and say, we need to buy some services from you. We need cutting edge risk management techniques that will keep us and you out of trouble. Because the only way that we can keep that symbiosis going is through focusing the mind on the management of risk. So claims management and risk management is at the forefront of any captive endeavor and is foremost in a captive owner's mind. And if you authorize this at the legislative level through statute, the way that CIFSIC was authorized, you're going to want annual, if not, from the beginning, quarterly reports about how are you managing risk. Tell us the techniques you're using. So this is not going to be something where we grab something out of the air and put it in place. This is something where we collaborate with people who know in order to make sure that the dollar being allocated is spent wisely. Very important point. Where do we at CIFSIC get some of our knowledge about the management of crumbling foundations? From the construction industry insurance companies. Symbiosis. And it will work here as well. I know it will through my experience. So good claims management, good risk management, those are the watchwords. And without them, and a good part of the feasibility analysis deals with that, without them, it is a state expenditure of money for a useless purpose.
Great.
Thank you for that. Thank you, Representative Wood.
Thank you, Representative Farrar. Any other questions here in the room? Okay, at this time, we're going to turn over to the former chair of the Insurance and Real Estate Committee, who is now at CCM, Brian O'Connor, to talk about CIRMA, which was put together in the late 1970s when we were on the brink of collapse with insurance premiums. And if, Brian, you can give us a brief overview on it, we can always, come revisit this, but, you don't have to go into super depth on it, but just talk about how that solution came forward and if that's something we should be looking at. Thank you, Brian.
Yeah, thank you. Thank you for the introduction. Welcome, Representative Wood, Representative Perry. Just really quickly, my Senator Crisco and I helped put together the first captive audience bill in Connecticut. I think it was 2007 or something along those lines. It was much more refined afterwards with Governor Malloy, so I'm glad it was able to be successful. Yeah, really quickly. Kerma is basically came about in the late 1970s because, as Representative Wood said, the insurance market was crumbling, particularly workers' comp at the time. So what CCM did is that we lobbied the legislature at the time to allow us to do a cooperative risk management agency and form one with municipalities. And I think this might be a model that the nonprofits can do. Now, we started out very humbly. I think we started out with 16 towns in the first year, and at the start of the second year, we got another 9. Currently, I believe they have, as far as individual towns, I think they're close to 135, I believe, out of the 169 towns. The others may use them through TPA services, third-party administrators. So it's been a very successful model. And I think one of the things that was key was by combining the resources, they could stabilize costs, share losses, and also manage the claims collectively. And I think that was one of the key things, is that the traditional insurers, it was just cost prohibitive for them. They were losing money on it, so they got out of the market. And I think, to Michael's point, is you try to get that symbiotic relationship where you want to keep them in the game. And I think by Kerma being formed and managing risk for the majority of municipalities, it's been able to lower the costs, and it kind of keeps the private insurers involved. That said, I believe that Kerma has 90% of the market as far as municipal entities, but there are still opportunities in the private sector as well. And I think that that's important to kind of point out. One of the things too that I think was key, now on the workers' comp side, I don't believe they were seeded money, but on the liability side, which I think is where the nonprofits are having their biggest issues, not on the workers' comp side, we were capitalized. I believe it was, you know, I don't know what it would be in today's dollars, but it was $8.6 million at the time. It was a loan, and it was paid back by, I believe it was a 15-year term, and we paid it back by 2001. And that has helped, again, you know, at the time in the late 70s, it was becoming more unattainable. And I think that's what's happening right now in the nonprofit sector. And by putting that in place, you know, I think it was 7 years later, they were basically caught it before it was too late, so to speak. And it's been very, very productive. So, those are some of the key features. I do want to point out, though, you know, I think it depends on the risk pool for the nonprofits. It looks like childcare entities are the ones that are facing the biggest hits, just because of the, you know, the liability of those entities. And what happened with Kerma, we actually had a competitor at the time, Murma, but they weren't capitalized. It was municipal and sort of local risk management. And they weren't capitalized enough. And eventually, because a lot of the smaller towns actually went there, they're like, why should we support and be a part of a larger group that had police, fire, and public works, bigger departments that might have greater liability exposure? So I think you have to keep that in mind, is to, if you're going to have this entity, that it kind of works for all the different entities. And I think one of the key things with Kerma as well is that because we are member driven, we do provide basically reimbursements. I guess it would be called a dividend, actually, to our members. And they've been able to pay that out, and it kind of, you know, give the money back. So I think that's sort of the difference between us and the commercial carriers. And I think that's been helpful. And as far as, I just want to make a point on the tort reform, CCM, we're actually very much committed to that as well. I think it's going to be a part of our legislative agenda this year, because a lot of the awards are becoming astronomical. And so we're looking for caps as well. And I think it's just to kind of, again, to provide predictability and stability in the rate making or premiums. So I'd be happy to answer any questions. Also, he apologized he wasn't going to be able to be here because of travel, but Dave Demchek, he's the CEO of Kerma, which is a program of CCM. He'd be willing to either meet with the chairs or the group itself to answer any questions. So he would make himself available to you.
I just have one question, then we can go to Senator Austin. What is there staff with Kerma? Like, what's like, how many people does it employ? Do you have a budget?
It employs, I believe it's about just over 100 people, let's say 110. CCM on the other side of it is, I think, another, just me and some of my colleagues. I think we're 25.
Okay. Senator Austin.
Thank you. So I do want to say, Brian, that part of the real help for Kerma has been coming up with a fee structure for the hospitals, because even after the setup of Kerma, the fee structure for hospitals was not there. I know I worked on that, and ever since we had that fee structure for hospitals put in, we've seen double-digit decreases in the cost of workers' compensation because we were holding down the costs relative to workers' comp. And all the goal in workers' comp is always to get workers back to work. That we put a lot of money into training workers. We want workers back to work. So I just wanted to just point that out so everybody realizes it wasn't just the impact of setting up Kerma, which was around for a long time. And I worked on that with Jim O'Brien, who spent some time up at the legislature, and he was fantastic. And I put in the legislation relative to that fee structure so that hospitals were not overcompensating on the workers' compensation side, which happened back then. But double digits decreases, so I think we're about 50% less than we were a number of years ago. So I just wanted to point that out. Thank you.
Thank you, Senator. And Lisa?
Thank you. I just wanted to also make a point that it's not just the childcare population. While you're right, Brian, that's so huge, but also when we were after this huge claim that was hit to the connection, when we were getting responses back from the 17 insurance companies that refused to carry us, they also wrote comments like community justice population, residential programs, housing programs. So they were also the specific agency that we had, our insurance, felt that it was a very high risk. They were also asking for either critical incident reports that they wanted to see from our quality insurance department, which we have a very robust risk department. And they were also wanting to see any reports that our funders had to say about our residential programming. They wanted to look at those as well. So it has now spilled into other populations that many of the nonprofits serve, not just childcare. So I wanted to make that point. Thank you.
That's a great point. And I think that's actually one of the things is you want to be able to spread out that risk. So if you can, if they're refusing to underwrite your organization and others, then that's obviously the biggest problem that you have. And hopefully that some of the other ones that are lower risk would join a pool.
Right. And as far as, when you talk about, obviously, sexual molestation, as we've talked about, is a huge issue. The other thing I think to keep in mind is, right, there isn't a day where we're not seeing something on the news that talks about people coming back 20, 25 years later, right, to a situation where they were sexually molested. And that's all over the news. It's everywhere that we look. So it's also what we heard is the fear of, which could be any institution, it could be, sort of any situation where people may come back later, right? To, sue an organization for saying that they were sexually molested or abused. So, that realm could encompass many things, right? So that's the reason why, nonprofits spend a lot of money. Of course, we have to doing background checks on our staff, right? And doing all of those other things, because the possibility of where that could happen literally could be anywhere across your organization. It doesn't have to specifically be criminal justice, childcare. It sort of, encapsulates any other potential risk that you have in your organization, which we may not be able to identify. So really, they're sort of looking at nonprofits as risky irregardless based upon where the possibilities could fall.
Any other comments or questions? Ben?
Thanks. I just appreciate both of these presentations. I think from our perspective, we really don't know yet because there hasn't been this feasibility study, whether there's like the pluses and minuses in our particular situation for pursuing a model that's similar to one that Mike just laid out or similar to Kerma. In both cases, these are things that were supported heavily with the financial investment, at least initially in Kerma's case from the legislature and the governor's office. And so that's what we hope the next step will be. We really, and that will happen relatively quickly. We don't think it's that complicated of a thing to do, but it does need an actuary to do an assessment of our industry. I know Ava's here of the childcare industry as well. That's having these issues and put some numbers on the estimates that Mike had and otherwise, what would it cost both to capitalize a program so that if it starts and there's a claim, it's able to respond to the claim. And then also, very importantly, what would it cost nonprofits to continue to pay premiums into it? Kerma is obviously very attractive to municipalities because it's competitive, very competitive on a cost perspective in the marketplace. And so I think we are just to say, I think we are a little bit concerned about segregating the riskiest parts of the nonprofit business, whether that's a particular population that's being served or a particular area like sexual abuse and molestation coverage that insurers are finding to be the most risky. And so that's why a captive seems attractive. But I think that the devil will be in the details here. And so our interest, hopefully, maybe it's something that can be figured out prior to the start of the next legislative session, is to get this study underway so that we can have a better sense of here's exactly a solution that we all need to pursue to help the nonprofits that are providing these services on behalf of the state. And so I know tort reform is a part of that. Conversations with the Attorney General's office about that that you talked about, Representative Wood, are part of that. I think both of those issues are related to this, but are not exactly this. And so we need to get a handle at least on what the insurance picture might look like if we worked on creating an entity, even if we're also sort of in parallel working on those issues, if that makes sense.
Yeah, so what Ben is referring to is we tried for a few years to get a feasibility study done. Senator Austin was very helpful in finding $50,000 is what we were looking for at the time for the insurance department to do the study. For whatever reason, that did not make it, this past session. So why don't we talk, Ben, offline, considering there's discussion of a special session and things, making that happen. And I'm sure there's a lot of support to see that sometimes, for whatever reason, things just fall through the cracks in the last days of session. But I can't think of a more worthier topic for us to spend $50,000 on. So we'll talk about that offline. Why don't we also, if anyone has any thoughts, we can always, Allie and I get a lot of people reaching out to us after these meetings saying they want to present and they want to share some things. So we do have a list, but if there's anyone here that says, hey, we need to have, this topic covered at our next meeting, feel free to use this time now to share that with us. If anyone has any feedback, if not, you can talk to us after, but I think this is a good stopping point and we will meet again in 2 weeks. Any other comments or questions? Great. She left her hand up. Okay, great. We'll see you in 2 weeks. The meeting's adjourned. Thank you.